now that you figured out that the LLC is really for business owners who are just getting started, you've switched over to an S corporation, which means your business profits are more than $50,000. Now that your business profits are more than $50,000, you need to know how to use your S corporation. And I have 5 different ways in which you can use your S corp. As soon as you make the transition from an LLC to an S corporation, you are going to want to get paid, and you can get paid in the exact same way that you got paid as an LLC owner, which is through distribution. When an LLC owner converts to an S corporation and decides to transfer money to themselves personally, it's called an owner's draw or an owner's distribution. At the time that you take the money out of the LLC that's been converted to an S corporation, it is non-taxable income at the time. Will you eventually pay taxes on this later? Absolutely. But one of the benefits to being a business owner is that you can take money out of your business as you need to, and then you pay Uncle Sam when it comes to April 15th. That's one of the many benefits of being a business owner. But after you get past just taking distributions, one of the things that you'll notice as being an S corporation owner is that the IRS has a rule that states that S corporation owners have to give themselves what's called a reasonable salary, which is a W-2 from the S corporation. Now, normally in our office, we typically recommend that your reasonable salary is based off of whatever your profession is in your state and in your zip code based on your area. But we also want to make sure that it's somewhere around a third of the business's net profits. So if my business netted $100,000 or $1 million, that would be $30,000 in a W-2 salary. Or if it was $1 million, it would be $300,000 that I would be taking in a salary, which means that the W-2 side of the salary is what is subject to self-employment tax, which is 15.3%. It is now called payroll taxes for you instead of self-employment taxes. Will you have to pay Fed and state taxes on this amount that you give yourself? The answer is yes. But when you decide to issue yourself payroll from your own S corporation, you can choose with ADP, whoever you're doing payroll with, whether or not you want the federal and state taxes being taken out of the paychecks that you're giving yourself from your own business. The reason why you can choose to not withhold your federal and state taxes from the money that you're taking from your business is because you might want to reinvest that money into other things that's going to turn around and give you tax deductions that would result in you not having to pay as high of federal and state taxes on the salary you gave yourself. For example, if you invest in real estate and you get to use the depreciation to offset your S corporation's flow through income, then you're probably not going to want to pay so much into payroll taxes and have the federal and state taxes being taken out on the amount you paid yourself. So this is why we kind of time payroll out throughout the year. Another thing to take into consideration is you still can take distributions even though you're taking a salary. So the salary is the portion that the IRS says that you have to take. Distributions is however much you want to take. But I always encourage business owners to always leave enough income in the business to be able to cover expenses, cover taxes, and cover payroll. That's how you run a successful S corporation. Now, outside of just taking distributions and outside of just giving yourself a salary, as an S corporation owner, you might migrate into wanting to do some of your own retirement planning. It's important to take that into consideration, even though some business owners that I talk to are not really enthusiastic about 401ks, and I get it. You don't get to touch the money until you're 59 and a half. It's understandable. But you have to realize that the 401k is still a tax deduction for you. And as a self-employed individual, no one is planning your retirement for you. If you decide you can set up distributions for yourself, give yourself a W-2 salary, and contribute to a 401k in the same year. And the IRS will allow for you to contribute as an employee, and you get to contribute as an employer, which is part of the reason why taking a good enough salary matters to you. Because on the employer side, you're only able to contribute to your 401k up to 25% of the wages that you gave yourself from your own corporation. Keep this in mind when you're doing your own tax planning for 2024 and futures beyond. Once we've migrated from just taking distributions, taking a salary, we even had leftover money in the business where we felt it was important to start funding our 401k. Now we can start going into some more advanced strategies to bring down your tax bill. And one of those advanced strategies I like to utilize is the Augusta Rule. The Augusta Rule will allow for you to establish a rent agreement between yourself and your S corporation. These two people are different parties, and the IRS will allow for you to rent your primary residence to your S Corp for 14 days in the year. What this means for you is that if you can come up with comparable rates on your size of your house to be able to utilize that space for business, we can turn around and charge a fee to your S corporation, which becomes a tax-free distribution to you for utilizing your own house for business. Last year in 2023, my wife and I threw a couple of events that were marketing events and mastermind events. The reason why we did this is because I wanted to utilize the Augusta Rule, where I rented out my primary residence to my S corporation, Tax Alchemy, and I got a tax deduction for it. I looked up comparable rates of the size of my house online. I even called a couple of hotels, determined what it would look like to rent out their spaces, and I was able to formulate comparable rates to draft a rent agreement to charge my S corporation to get a tax-free distribution, which created another tax deduction inside of my S corporation. Hopefully this is making sense, but this is part of the reason why we do tax planning ahead of time. But maybe you're already past the Augusta Rule and you want to go a little bit further. So we have the S corporation. We can take tax-free distributions. We understand we have to give ourselves a salary. We set up a 401k because no one's planning our own retirement. We did the necessary steps by getting a rental agreement in place, making sure we had a primary residence, and we pulled comparable rates so we can do the Augusta Rule. But how do we get our family involved? One of the ways in which we can get our family involved in business is twofold. We can add some of our family members onto the board of directors for S Corporation, and maybe you can take a traveling trip once in a blue moon to have a board meeting somewhere different than where your business is located. That's always fun. But if you really want to leverage your children every single year on your tax returns for helping you inside of your business, one of the things that S corporation owners can do is establish a sole proprietorship or a LLC that's a family management company, or an FMC. And what a family management company will allow for you to do is it allow for you to have a separate bank account separate from your S corporation, where your S corp can pay a management fee to the sole proprietorship or to the LLC. Part of the reason why we established this entirely new entity is because if I add the children onto payroll through the S corporation, we are going to pay payroll taxes inside of that S corporation for placing our children on payroll. That's something you have to take into consideration. I'm not saying don't do it, but you are going to have to pay payroll taxes. If you want to avoid payroll taxes and still be able to give your children $14,600 each child, which is over $28,000 in a deduction, I would encourage you to look into setting up a family management company, either as a sole proprietorship or as an LLC. This could be in the same state that you're operating your S corporation. Guys, this is only 5 strategies that can help you reduce your liability with your S corporation. 5 things to take into consideration for 2024. Inside of my office, we leverage over 212 strategies inside of the S corporation. I got a couple of more videos that I'm gonna have to work on for you, aren't I? Thank you so much for watching this video. I hope this gets you one step closer to building your business the right way, and I hope this helps you on your journey to finding tax-free wealth. My name is Karlton Dennis. You know what to do. Like, comment, subscribe. Share this with one other person that's growing their business, and I'll see you on the next video. Cheers.